Good afternoon everyone, welcome to the Landlord Investor Show. My name is Simon Howitt, Head of Tax for the property team here at Acuity Professional. We've spent the last 5 years, you've probably seen me here before, talking about things like the landlord tax, the dreaded Section 24, inheritance tax and capital gains tax. Well, today we're going to press pause and I'm going to introduce you to a brand new subject that I think is the biggest thing to hit our industry since buy-to-let mortgages came around. It's going to be a real treat, so make sure you're comfortable, you've got your cup of tea, you've got your feet up, and I'm going to introduce you to some new people. Stay right to the end, because at the end you're going to get a token that's going to save you a ton of money and make this whole windfall thing come alive for you. So, many of you are thinking, who is this seminar for? Well, let me tell you. The first group is landlords with mortgages in their own name. The second group are people that have a mortgage and are looking to get into the business, or maybe you're renting right now and you can tell other people about this good news. The third group is people that run PIN networks or property community groups or WhatsApp groups where they're sharing with other landlords what's going on in the industry. We'd like to talk to you. And then the final group is anyone related to the property industry, such as letting agents, insurance brokers, mortgage brokers, anybody that has people with multiple or single mortgages as part of their community and would like to get on board with this fantastic good news. So now we've told you who this is for, let me also just acknowledge that I think in this industry, certainly in the last 5 years, last 10 years, last 2 years, certainly in the last 18 months, the levels of pain that we go through as landlords has increased. We've seen increased taxation with the threat potentially of this white paper that's come out from the Office of Simplification of Tax, now looking at potentially capital gains tax being increased to 40%. We've seen the rights of tenants be increased. We've seen lettings outages, particularly in the HMO sector in this last period during COVID. It's been bad news, it's been tough, it's worn a lot of you down, I get that. Well, guess what? Today will be the turning pivot point as you hear this good news story that if you have mortgages in your name, will apply to you. So, folks, let me tell you the things we're going to talk about today. My first big subject on the agenda is mortgage refunds. This is the really exciting one. We're going to do a deep dive on that and then you're going to meet the team. Then at the end of that, we're then going to talk about what happens as a result of having a mortgage refund when $500,000, million, $2 million, for some of you, multiple millions lands up in your lap. Because the one thing most of you can't do is use that money to pay down your mortgage debt, because there are restrictions on how much capital you can pay down each year. However, the good news is I have a fabulous investment team here that will show you amazing returns that you can get and the wise things you can do with that kind of money to double your wealth and to protect your wealth. And then finally, little old me, I'll come back to talking about those of you that are here today to find tax solutions from the #1 team in the UK that have been doing inheritance tax planning, capital gains tax planning and Section 24 planning to get you instantly out of some of those situations, or at least to put a plan in place so that you and your family can enjoy the wealth that you've created over the years. So now I'd like to introduce to the team Bryant, who's a director for the company Mortgage Refunds. He's going to come and join us. Come and join us, Brian. Brian's going to tell you his story as he was introduced to this, and pin your ears back. This is exciting. Over to you, Brian.
Hi everyone, I'm Brian Croucher. I'm a fellow landlord, and I got started on this process back in 2016, the good old days when we had property networking evenings. And I was at a PIN meeting, one of the Simon Zucci meetings in Bristol, and these two well-dressed gentlemen stood up the front in the 20 seconds that they could introduce themselves. And that they said that they'd formed this company, that they brought some of the top brains from both the banking industry and the legal industry together. And they'd identified a major flaw in the way that banks had actually sold mortgages on. And what they were looking for was some landlords to act as guinea pigs when they were just launching their system. So it was quite funny because at the break, absolutely nobody went to speak to them. There was, in the far corner, there was someone doing a deal clinic on an HMO, and everyone was saying, let me see. And these poor guys were on their own. So I didn't do anything. I didn't take action. But in the main presentation, it just kept nagging me. What if these guys have got something? What have they got? So the main presentation was lease options with Simon Rudgick from MS Law. So if you're watching, Shimon, sorry, I wasn't watching. I was thinking about these two guys, and was I just in the right place at the right time? And I thought, I've got to take action. So at the end of the presentation, I actually went up to them and said, hi, I'm Brian, I've got 23 mortgages, how can I help? And they said, you're exactly the sort of person we want, because this is for you, this is for landlords. What we'd like to do is to invite you up to head offices in Blackpool, show you the team, and just tell you what this is all about. And that's exactly what I did. I got on the train and went up to Blackpool, and I spent the whole day, and they explained, most of it went way over my head. They're talking about the theory of money and what happens when a mortgage is securitized or sold. But I knew that underneath it, there was something in it that had to be good news. I didn't understand the technicalities, but I knew this was good news. So when they invited me to put my mortgages into their system to be processed, to be acted as guinea pigs, I thought, why not? The downside is it's going to cost you £1 per mortgage. So I did. I put my mortgages through, all 23 mortgages. I loaded onto the system that day thinking, well, I've got nothing to lose. Let's try it. Let's see what happens. And to cut a long story short, 3 months later, I got my legal reports back, and I'll show you one later on. But it showed me that of the 23 mortgages that I'd loaded, 22 had been sold off to whoever. They don't know. They were not with the original bank that I had. So Mortgage Express, nope, they've been sold. Birmingham Midshires, nope, they've been sold. Northern Rock, nope, they've been sold. Bristol and West, nope, they've been sold. I had no idea this has been going on behind my back, and that's what I found. So what I'm going to share with you later on is a deep dive on exactly what's happened, because over the 5 years since I had that first meeting in Blackpool, I've been closely involved in this, in the process that they've been going through as a company, some of the pains and some of the great results that they've had, and I'm going to share those with you. And in the course of that, I've been talking to the legal team, I've been talking to the lead barrister, and I've picked up quite a wealth of information, and that's what I'm going to share with you, my 5-year journey from 2016 to 2021, because it's well worth you listening to. What I'm going to share with you is exactly what I've done with my mortgages and what you can do with yours right now.
So thank you, Brian, for that introduction, and we'll come back to you shortly. I'd now like to introduce you to Phil Bryant. Come and join the film.
Thanks, Simon.
Tell me who you are, Phil.
My name's Phil Bryant. I'm the head of our regulated financial planning team at Acuity, and I was introduced to this proposition last year and found it incredibly interesting. We very rarely have the opportunity to create wealth, and I decided to take the journey myself and go through with my mortgages, and the report that's come back that Brian mentioned earlier has confirmed that they've been securitized. So I'm very much looking forward to the next stage of the journey.
So you got your Christmas present early?
Hopefully.
Good, and same for us, in our family, I think we've got 49 properties now. We did the same, we applied, it cost us pennies to do in terms of the whole context of this, and sure enough, we did a little bit later. We're starting to get our reports coming back now, again confirming the same thing. So we're all very excited, and I'm coming to you for some investment advice later on what to do with all this money that gets paid out.
And we're going to speak about that a little bit later on today.
Thanks, Phil. So here, we're now back with Brian, and now we're going to start the journey of really getting into this. So the first question really, I suppose, Brian, is what have the banks done that's so wrong?
Thanks. Okay, let's go back to 2007, the credit crunch. As a result of that, what happened is the banks signed up to a treaty. It's called the Basel III Treaty, because it was signed in Basel. And as a result of that, banks were restricted in the amount of lending that they could do in relation to the amount of liquid assets they had. And it was a multiple of 13 times. So for every £1 million in saver deposits or other liquid assets, a bank can lend £13 million. So what happens when a bank reaches its limits? It can't lend anymore. Well, banks are there to lend money. So what they do is they bundle up the mortgages into what's called a mortgaged-backed security, and hence the word securitization. And that bundle of mortgages is then sold off to another institution, typically a pension fund or a mutual fund. It could be in the UK, it could be in Europe, it could be in the States. We don't know. And what that does is it resets the capital adequacy back down to zero, or certainly reduces it, and the banks can lend again. Then they fill their mortgage books up again and sell it again. And so they go round and round the same cycle. What the legal experts have identified are 4 fundamental flaws in the way that this securitization process has actually taken place. Now, the way it should happen is that lender A sells to lender B, and the first legal charge of lender A on the property is removed, and lender B's first legal charge is put back on the property. Lender A writes to you and says, we're now selling your mortgage to lender B. And lender B writes to you and says, we're now your lender. Here are our terms and conditions. Here's the direct debit, and away you go. Now, sometimes that does happen, but not in the vast majority of cases that the team have analysed. That is not how it happened, and this is what gives rise to the situation, the opportunity that we've got today. What happens is the banks use what's called the power of attorney clause that's in a mortgage. You don't even know it's there, but it's hidden away in the terms and conditions, that they have the right to do whatever they like with that particular mortgage. So they bundle them up into what's called SPV, special purpose vehicles, and then they sell that vehicle to another institution, typically a pension fund or a mutual fund. Now, what's the problems with that? Well, they don't tell you about it, and you continue. Let's take, for example, Birmingham Midshires. Once after it's been sold off, your mortgage debt has been sold off, you're still paying Birmingham Midshires your monthly mortgage costs as if nothing's happened. But Birmingham Midshires have got no right to receive your ongoing payments because they don't own your mortgage debt. It's been sold off. Yes, you owe it to somebody else, but you should not be continuing to pay your original lender once that mortgage debt has been sold off. So that's number one. Number two, when the mortgage debt has been sold off, the original lender has no right to keep a first legal charge on the property because the mortgage has been redeemed in full, albeit by a third party. Third flaw that the legal team have identified is that you've got no agreement with whoever now owns your mortgage debt. You don't even know who they are. You didn't even know it was sold. It's been sold without your knowledge. So therefore, there is no agreement whatsoever with whoever now owns your mortgage debt. Now, why is that the case? Because in most circumstances, that new company that owns your mortgage debt is not FCA regulated to lend. It's a pension fund or a mutual fund. That's not an institution that can lend money. They're banned from doing it. Hence, they cannot put a first legal charge on a property. And those are the 4 big issues that the legal team will challenge your mortgage lender on, and they're expecting significant results from it. And I'm just going to show you an example of one of my own reports. Just take one. I've got 22 or 23 of these actually, and 22 came back securitized. So what exactly does it mean? I actually asked that of one of the legal team, and he looked at my report and he said, "Yeah, Birmingham Midshires mortgage. Yep, taken it out in January 2004. Yep, that's right, I did. Amount of the mortgage was £117,500. Yep, securitized in March 2006. So for the last 15 years, Birmingham Midshires no longer has my mortgage debt. They continue to act as if they were my lender, but they're not. All they are is an agent working on behalf of whoever owns my mortgage debt." So the legal expert told me, well, we can actually reclaim all your monthly payments back from today's date, right back to the date when it was securitized in March 2006. And I just stood there, my mouth open, what? And we worked out that on an average, earlier on in the mortgage, I was paying about £300 a month. With base rate reduction, it's now about £200. So we took an average of £250 a month that I'd been paying to the Birmingham Midshires right back to March 2006. And we multiplied the 250 by 12 months in the year, and 15 years. And that came up to £45,000 that the legal team say, we can reclaim that for you. And they said, but that's not all. What? That's not all. We can also add and claim back 8% interest per annum, which added up to 25,200. So my total claim, just on this one element for one mortgage, was £68,000. That's what they are attempting to, or challenging and trying to get back for me now. £68,000. And that's when the penny really dropped. I could actually see it in black and white, how they came to get these figures. Multiply that by 22, and that gives a lot of money. And that was my jaw-dropping moment, and I suddenly realized the significance for me as a landlord with my little portfolio, what it meant. And I say to yourself now, think about your own portfolio. If my portfolio is worth over £1 million in terms of potential reclaim from the lenders, what's it worth to you? It's well worth having a go, guys.
Brian, that's amazing that you've got that kind of amount on one mortgage and you've got another 23 mortgages to go. I quite wonder where that claim size will come to. I think he needs Phil's help at some point. Anyway, if you're sat there now hearing that message, you're probably thinking, gosh, how does this apply to you? And that's a great question. There are three qualifying key criteria. One is that you have to be with your existing mortgage lender for a minimum of 3 years. Why? Because as Brian's already said, within that first 2 to 3 years, they will have securitized your mortgage, bundled it up, and sold the mortgage debt on. Number two, your mortgage needs to have 2 to 3 years left on the entire term, because we're going to go through a process now and we don't want to get to the end of your mortgage before that process ends. So it's not the current deal, it's the total term, 2 to 3 years left. And then finally, that you are not in arrears, that you are up to date with your payments, because people in arrears we can't go through this process with, because of course the banks will just press pause. And people also say to me, Simon, what about the holiday payment, 3-month holiday payment I took during COVID? That's fine, it's just a mortgage extension, so no real issue there at all. So that's the qualifying criteria. Now then, you're going to see appear on the screen behind me a list of all the 66 plus mortgage lenders who currently we know have securitized their mortgages and sold them on. So if your mortgage lender appears on this list, then you need to apply at the end of this presentation, and we'll show you how at the end. However, also note, there are some lenders such as HSBC and Barclays and others that currently do not appear on that list. Don't worry, they'll be coming a little bit later. So as we go through this process over time, more and more lenders will be added to the list and we'll keep you updated. So now we know the list of lenders, and if your lender's on that list, then I can feel the excitement coming through the screen already. And secondly, if you meet the criteria, you know you can go and make an application. But of course, now the major question is, how do I apply? How do I start this process? So I'm going to ask Brian to come in here and explain how we do the process, how it starts.
Thanks, Simon. Right, the process, it's a two-stage process, and the two stages are very detached. They don't just roll in from one to the other. Stage one is a data validation. It's a very sort of, a benign thing to do. We just find out, get your mortgage details from the lender, and we find out whether or not it's been securitized, and if so, whether or not there's a claim. And you get your legal report that will tell you. Once you get the legal report, there are three things that you can do with it. One is to just, okay, I don't want to do anything now, I've changed my mind, just do nothing. Second option is to give the report to your own solicitor, and you can get him or her to process the claim for you. Or thirdly, you can give it back to the legal team and say, yes, activate that on a no-win, no-fee basis. So the first stage is to go to the website, yourmsc.co.uk, yourmsc.co.uk, click on apply now, answer some basic questions, and then enter your mortgage details. When it comes to the payment section, you'll be, don't worry when you see it, because it will say £260 per mortgage. Don't worry about that, because what we've got for you is a voucher code to use, and we'll give you that at the end of the webinar. And what that does is brings the cost down from just from £260 to just £1. Okay, now little bit of a treat for you is because if you're a portfolio landlord and you don't fancy the job of entering all your mortgage details online, what we can also offer you is a done-for-you service. So if you're a portfolio landlord and you'd like to take advantage of our help and actually doing all the data entry for you, just for the first stage, okay, just for the data entry, for the validation phase, then drop us an email. And the email address is help@mortgagerefundoption.co.uk, okay, help@mortgagerefundoption.co.uk, if you'd like to take advantage of our done-for-you service, and we'll do all the data entry for you. Okay, so 2 options for you to choose from.
Thank you, Brian. And don't worry, folks, the information that he referred to there will keep popping up on slides, and stay right to the end to get the token, because that £1 saving when you've got multiple mortgages makes a huge difference. Thank you, Brian.
Okay.
Good. So now we're moving through the subject. And I think at this stage, the experience of Phil, myself and Brian over our time of introducing this to clients is, apart from a lot of excitement and a lot of positive responses, has been quite a lot of questions, and they're all really, really good questions. So what we're going to do now is Brian's going to go through a series of questions with you, which is great. And by the way, again, the website will come up with the URL that you can go look at, which is our website, and on there will be an FAQs that we've filmed. So if we don't get the question that you've got today, you can go through there too. So don't worry, folks. We'll either get it today or we'll get it on the FAQs on our landing page too. So Brian, away you go.
Okay. The number one question I get asked all the time is, if I do put a claim in, will it affect my credit file and will it affect my ability to lend? The answer is no, definitely not. The FCA have very clear rules on that. Lenders can't just blacklist you, and that doesn't happen. And think of all the tens of thousands of PPI claims. There's not one reported incident of anybody's credit file being adversely affected. So no, your credit file won't be affected in any way. Second question I get asked very frequently is, well, I'm no worse off. Why would I want to make a claim? What grounds? I've still got my mortgage. And the illustration that I use is my Boney M CD. It could be any old CD, but I just picked my Boney M CD. So imagine, okay, I've got a Boney M CD, and a friend of mine says, can I borrow it for the weekend? I say, yeah, sure. Help yourself. Enjoy listening to it. So my friend takes it away, and what he doesn't tell me is that he's made 100 copies of it, and he's sold them on eBay for £10 each. And on Monday, he gives him my CD back and says, thanks very much. I'm no worse off. I've still got a CD, but my friend, so-called friend, has made £1,000 from it without telling me, without my consent, without my knowledge. And all I'm saying, when we relate it back to the mortgage claim, is you've done that. You didn't even tell me about it. You've been masquerading. It's deceit. I want a share of the action. So I would say to my friend, I might admire his entrepreneurism, but hey, come on, it's my CD. I want a copy of. I want a share of your earnings. What you've done is wrong, but okay, you've done it. So just give me a share. And that's exactly what we're saying with the mortgage. What you've done, banks, is wrong. Just like a share of the profits that you've made. How long will this process take? That's another good question. The data validation phase normally takes about 3 months. You should only take 28 days, because under the Data Protection Act, the banks have to respond within 28 days. But what they do is they give you they give us a dribble of information back, and then we have to ask them for more information, and that resets the clock in another 28 days. It normally takes 3 cycles to get that information. So the first stage normally takes about 3 months to complete the data validation exercise, and after that you get your legal report saying whether or not your mortgage has indeed been securitized and whether or not you're eligible to submit a claim. So that takes about 3 months. Then, if you decide that you wish to go ahead with the claim, then that's, well, how long is a piece of string? It's going to take, we estimate, between 12 to 18 months in the event of a negotiated settlement with the lender. If it has to go to court, it could take years. That's not what we want to do. The legal team are keen to get a negotiated settlement within the earliest timescales, but we're looking realistically 12 to 18 months, but I can't guarantee it. That's just best estimate, okay? How much does this cost? Well, when you go through the data validation exercise, once you've input all your mortgages information into the online system, you go to a payment section, and with the voucher code, it comes to £1. So in my case, I've got 23 mortgages that I put through. It costs me £23. And that is the only outlay that I will have, because when my reports came back, I actually said to the legal team, yes, I'd like you to file a claim for me, please, on a no-win, no-fee basis. So the answer is £1. That's all it's going to cost me. How much can I expect to get back? I covered that earlier. It depends on A, the size of your mortgage, and B, how long you've had it. So give the example of the Birmingham Midshires mortgage that I've had since 2004. I'm expecting to submit a claim for about £70,000, something like that. So we're talking big monies. We're not talking hundreds or £1,000. We're talking tens of thousands of pounds per mortgage. Have you got any proof that a bank has actually securitized the mortgage debt, sold the bank the mortgage on? The answer is yes, I have. It's a very interesting one, because a few years ago, I don't know if you've got Mortgage Express mortgages or had them, but I have 7, or had 7, and I got a letter saying we're selling your debts on to Bryant. And I phoned up the legal team and I said, I've got this letter. Oh, my Mortgage Express mortgages are being sold on to Bryant. Does that invalidate my claim? Does that mean I can't go any further with them? And there was silence for a bit, and they just said, check the balance sheet of Topaz Finance. So it's Topaz Finance trading as Bryant, trading as Rosinka, trading as Melanite. Check the balance sheet. So I did. I went on to Companies House. I've actually got it here. This is the latest filed accounts for Topaz Finance. And I went to the balance sheet, and with all these thousands of mortgages that Topaz Finance has bought off Mortgage Express, what would you expect to see on the balance sheet? You expect probably millions of pounds on the balance sheet. Their actual current assets, this is off their latest accounts, £15,064. And I was looking, is that times a million or something? No, £15,000. That's it, guys, of which cash at bank and in hand, £11,140. In other words, there are no mortgages on the balance sheet of Topaz Finance Limited. They have not bought any mortgage debt. What they bought was the account management. So that's absolute proof, just for this one example, that when Mortgage Express sold their mortgages or the mortgage debt onto Topaz Finance, that did not happen. They'd already securitized it many, many years ago. What they actually sold on was the account management. And that's the sort of charades that's going on, not just with Mortgage Express, but with other banks as well. They're purporting to be your lender, they're not. Okay, another question that I get asked frequently is, what if the mortgages are held in a limited company name? The Data Protection Act only applies to residential mortgages. That's the only way that we can get the information from the lender, is if it's held in personal name or names, up to 4 people. If the mortgage is in the name of a limited company, I'm afraid we can't help. It has to be in personal name or names. The other thing to say is, if you've taken good tax planning advice, if you've got a portfolio and you've assigned the beneficial interest into a limited company, that's fine. What matters is in whose name is the mortgage. If it's in personal names, you're in business. If it's in a limited company name, I'm afraid we can't help you.
Brian, that was fantastic. Thank you very much. You better take those, for God forbid that I make some copies of them. Thank you, Brian. So folks, a lot of information to take in. If you'd like to know more, you'd like to see the list of who the lenders were, you'd like to hear our FAQs, then just go to the URL that's going to appear on the screen now and that will give you more information. Or you can go direct to the site and use the token that you're going to get at the end of this webinar. And you can put that token in, and that's going to save you £259 per mortgage, only costing you £1 to find out if your mortgages have been securitized. Now, we don't know how long that discounted price is going to be around for, so don't hang about, go ahead and move on and do it. Now, for those that are going to sit back and and woulda, coulda, shoulda, not quite sure, I get it's not right for you, and if it's not right for you, then put it down. But for those of you that, like me, that like to take action, that can assess the risk reward and see actually the risk is really low. It cost us, I think as a family, £49 to find out if those 49 mortgages had been securitized. From where I'm sitting, that's money well set and puts us in a completely different perspective to be part of those people that could double their wealth as a result of this fantastic thing that's happening in the background. Now, I'd like to introduce you to Phil and have Phil come in now and talk about what do you do when you end up with £500,000, million, £2 million, £3 million, whatever it is going to be for you personally, land in your bank account free of tax. As a professional service firm, we have a responsibility to all our clients. And I think one of the greatest things, one of the greatest ways we can serve you is to look at your options when this money turns up in your account. So I'd like to bring Phil in now, who's part of our, or actually heads up our whole regulated division, to talk to you more about this. Phil.
Thank you, Simon. We're quite uniquely placed to be able to really add value to this space. I'm a chartered partner within the firm and I head up our regulated financial planning proposition. We're a multidisciplinary firm, so we provide expertise in terms of tax, accountancy, wealth management and estate planning, and it's about bringing those different disciplines together that gives us the unique opportunity to deal with these things in the most efficient and effective way for our clients. In addition to that, we're very used to dealing with landlords. Hundreds of my clients are landlords, and the firm itself has over 2,500 landlords, so we're very used to dealing with the very unique circumstances that come with owning and owning properties. Having a large sum of money land on your lap, it could be quite a daunting proposition, daunting prospect, and it's about not wasting that opportunity. We've never really had the opportunity to create wealth. As I said earlier on in the video, we usually deal with what's there, existing wealth, but to have a unique insight and a unique opportunity to be creating the wealth, we then need to be looking after it and advising in the correct way. We want to create, grow wealth, and then most importantly protect that wealth for future generations of your family. So it's vitally important that you seek the right advice and ensure that any windfall that is provided is looked after in the correct way. So I'd just like to bring one of my advisors in now. Alan, come and join us. And we'd like to look at the specifics really of what we need to think about in terms of this process. As I mentioned earlier, we're in quite a unique position to be able to help in this space, in that we're very used to dealing with high net worth clients. We're very used to dealing with landlords. We're an independent whole of market advisory firm, so we have access to the whole market. We're not tied to any particular provider or any particular fund strategy. What becomes very important when we're dealing with these sums of money is not just where it's invested, but it's how it's invested. It's looking at the structure, it's looking at the tax implications of that investment, it's looking at providing for future generations by protecting it in the right way. So this is where I'd like to bring Alan in. Alan, come on over here. When we're dealing with landlords, in particular in this space, that have received a significant amount of money and they're not able to necessarily reinvest that into their portfolio, what kinds of things would we be looking at? What kinds of questions would we want to ask those landlords?
Yes, it's a really interesting point, because as a landlord, a portfolio landlord, some of your options are going to be different to other sort of typical standard investors. So having this large sum of money, you've now got a window of opportunity where we can look at a range of options. So this is where we now look at lifetime planning and meeting your lifetime goals. So the first point of that is to make sure that we're going to protect that capital. So the reason why you invest in bricks and mortars is because of the impact of inflation. So one of the worst things you can do is leave it in cash. So we're going to be looking at a range of different investment options that you can go into.
And that's quite an interesting point because it gives landlords the opportunity to potentially diversify their assets. Nothing wrong, obviously, with property. It's held you in very good stead for a significant period of time, and it will do in the future. But it's one asset class. And I think the opportunity to have liquidity that comes your way out of the blue is an opportunity by which you can then diversify and look at different asset classes. The world has gone through a number of changes and will continue to do so. But what change brings is opportunity with regards to investing. And if it's invested in the correct way, with the correct vehicle, there could be significant returns that are available for you for your capital. What other kind of considerations would we want to be looking at with regards to these investments, Alan?
So alongside the investment, it's crucial that you have the right structures in place, because we're potentially looking at lifetime planning, as we said before. So it's for your immediate needs, your retirement needs, and the future generation. So what we aim to do, and what's quite unique to how we provide lifetime planning, is that because we have that multidiscipline that you were talking about earlier.
Yeah, and that's about seeing all different aspects. Sometimes when there's an advisor involved, they can have a slightly narrow vision of sight, but because we are experts in all the different disciplines, the legal, the accountancy, the tax, the wealth, the estate planning, we can build a full picture of an individual's assets and what they're trying to achieve and over what period. So, as I said earlier, we're quite uniquely placed to be able to offer insight into this area. And as an opportunity for us to actually try and provide wealth to people by sharing the message that Simon and Brian have been talking about today is really quite unique and exciting, because it's not normally the case that we can help provide that wealth. So what we want to ensure is, after the provision of it, that you're incredibly well placed to make the most of it. And it's about investing in the right way, via the right vehicle, over the right time frame. And we are very, very appropriately placed to be able to offer that very unique advice to help you through that journey. So I wanted to just give a flavour of the different investment options and opportunities that are available. Clearly different people have different objectives and different attitude to risk, but just to give an idea, the different kind of mechanisms that we can look to invest your money should you be successful with the claim. We can go into a very low risk environment that involves the smoothing of return over a significant period of time. That involves returning money to you when times are not so good, and the company keeping some money when the times are good. So it smooths out the volatility of an investment return. Another kind of approach we could look at is something like an all-weather fund, which tries to seek a return in almost all markets. So it's very defensive, and it will have correlating asset classes that if the FTSE drops, if the Dow Jones drops, if the price of gold drops, that they all move in a certain direction, but the correlation of these assets actually means that over the long term, the return that you can achieve is positive in all environments. So I think when we're looking at clients who are investing significant sums of money, this might be their first time that they've looked at doing this, or they might be very experienced investors, and clearly that has an impact on the kind of advice that we would look at. Alan, we spoke earlier about the different fund options and some of the performance that we've seen from some of the managers this year. Let the guys out there know.
Yeah, absolutely. And the benefit of being whole of market and independent is we do have the option of recommending anyone who sort of meets our due diligence and our sort of strong criterions. What we've seen is there is a range of investment options out there, and the range of returns marry up with the level of risk you want to take. So on the other end of the scale, where you're comfortable taking that level of risk, you can see returns post pandemic of this last year. We've seen returns of 80% in sort of a 12-month period, but that would be sort of uncommon in normal circumstances. And when you average that out over 3 years and 5 years and 10 years, you're looking at a range between sort of 5 and 8% as you go up the higher end of the risk scale.
I think that point about the pandemic, obviously everyone's aware of the pandemic, and I'm sure they're pretty sick and tired of being housebound, and hopefully we'll be out very soon. But it's a different kind of world for investing. There's different opportunities in different places, there's different risks in different places. Brexit has just gone through. There's been a different government over in the United States that has implications on the Chinese-American trade deals. So it's important that any investments are very strategic and they're aligned with our clients' objectives moving forward. Anything else you want to add to that, Alan?
like we say, with any investment advice, we'll make sure that it's suitable not only for you as an individual, but for your goals. So you can have multiple objectives and have multiple investment strategies that we're talking about. So you can have the smooth funds, you can have a high risk fund, and you maintain your property portfolio at the same time. So you have that diverse mix of assets aligned to your needs.
Yeah, we'd be delighted to have a conversation and help you through your journey. But the key message of today is really the opportunity that's been presented by the mortgage securitisation offer that we're talking about here. It really is, from an investment perspective in our financial planning team, is a unique opportunity. So hopefully you found that of value, and we look forward to engaging with you in the future.